to start paying attention. Why? Because when you come off of an edge of an extreme, like we came out of in February, actually, February, we were in a deflationary boom environment and we screamed over to the inflationary bust in the sell off that we had going into the end of February, all the way into the end of March and the beginning of April. April 1st, we started screaming in the direction of actually inflationary boom and then moved our way in that 1,500 point rally into the deflationary boom part of our regime tracker here. The edge that we were inside of here, we were pinned up against for the better part of a month. And we just came off of it again. And we've made 2 lateral moves. Why is that important? Well, the first thing that has gone on here, and I will associate this with the Federal Reserve, is that we got the FOMC meeting minutes last week. In reading through those meeting minutes, there is a unanimous hold, right? But the Federal Reserve was split between half thought that we were in neutral and half thought that we would have to hike rates just to get to neutral. And that is not a unanimous vote. That is a divided Fed. They also mentioned AI inside of the meeting minutes. So they were talking about the tariffs. They were talking about the conflict in the Middle East with Iran. And then in the same sentence, they named AI. So the build out, the data centers, the chip, all of the costs that are associated, all of the purchases that are going on inside of that. Every time there's a positive news event for AI, it's essentially associated with a higher possibility for inflation, and the Federal Reserve is less likely to cut interest rates. Meaning that the AI trade, it's dependent on low interest rates, and the more successful the AI trade gets, the more likely or less likely the Federal Reserve will keep rates at their current levels and have to hike them. And so we're in a now good news is bad type of environment. Now, going back to the regime tracker, when you think about this from the perspective of what causes this edge to come off of here, it's crude oil outperforming the S&P 500. It is also gold outperforming bonds. It is also gold outperforming bonds. Gold broke a short and is inside of a pullback. What is the 20-year doing right now? It is still at its previous lows. They are inside of 50% shorts. So what this represents here is, or are the bond markets weakening and gold strengthening, and crude oil going from falling to rising. And those 3 things, even if the S&P 500 goes nowhere, the ratios are changing. The ratios are changing. And it's a little bit deceiving when you're looking at just the S&P 500. But when you're looking at the NASDAQ, when you're looking at the Dow, when you're looking at the Russell, we could even go as far as to say when we're looking at, let's go take a look here real quick. What about NVIDIA? What is it doing? Now it's still in extension long levels. But where the NASDAQ has come all the way halfway back short, it can't even make it back up into resistance. This stream continues at eMiniAddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.